Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Palos Heights, and my co-host is Paul Munichel with Ameriprise Financial. Today is March 27th, 2023, and Paul's going to give us an update as to what took place. Lots of things going on, Paul. I'll just let you take it from there. It's as far as I want to go.
Yeah, I mean, the banks have been in the news a lot the last couple of weeks, and I'm going to hit on that topic a little bit this morning.
Okay.
So in the modern era, bank failures have predominantly been a function of bad loans. However, the Silicon Valley Bank failure and most ongoing system concerns are focused on the other side of the bank balance sheet, the deposit flows and the liquidity to meet withdrawals. The past year's sharp rise in interest rates led to two very basic and logical developments in the banking sector. First, the value of bank investments. Now, those are primarily Treasury and agency fixed income securities. They went down in value as interest rates moved higher. As we all know, bond prices fall as interest rates rise. Now, second, some bank depositors drew down their savings or transferred bank-held funds to other higher-yielding instruments elsewhere, such as money market funds. The data we have illustrates how this is affected the banks. We can show that the FDIC-insured banks experienced considerable unrecognized losses on their investment portfolios due to the rapid pace of interest rate increases. Though the losses would be assumed to evaporate if the securities were held to maturity, many institutions would likely incur losses if they were forced to sell the securities early to meet near-term withdrawal demands. Data shows an illustration of withdrawals from the system. Now, deposit levels surged during the pandemic amid the distribution of government stimulus and the forced savings that came along with many businesses simply being closed. But over the final 3 quarters of 2022, however, net deposit inflows turned into net outflows. Now, in Silicon Valley Bank's case, this was primarily due to a slowdown in venture capital fundraising, startup customers burning through cash, and to a lesser extent, capital transfers to higher yielding opportunities. More broadly, many banks are also likely seeing some net reductions due to consumer savings depletion and transfers related to yield chasing. However, according to the FDIC, deposit drawdowns through year-end 2022 were entirely driven by unsecured deposit outflows, so from accounts of $250,000 or more, and insured deposit levels increased. The data, again, sourced from the FDIC's latest quarterly banking profile, coming from the fourth quarter of 2022. Now, deposit outflows accelerated in recent weeks following SVB's collapse and subsequent system-wide concerns. Weekly Federal Reserve data on their H8 release show net banking system deposits as having declined by $119.5 billion year to date through the end of February. That's on a seasonally adjusted basis, with an additional $186.1 billion dropped through the weekend of the week ending on March 15th. Now, we believe the pace of deposit outflows should decelerate, notably in the weeks ahead, should financial system concerns subside. Lower market-based interest rates should also help narrow the gap between bank deposit rates and outside offerings, while also narrowing unrealized losses in investment portfolios. So there's a lot going on there. The news is covering the banks very diligently. I tried to break it down briefly on what's going on. We've got data to support and information further if you'd like it.
All right, very good. And I'm going to also explain what Ameriprise had shared with us effective this morning. The U.S. Stock Index futures are higher this morning after a 1% plus or better week for the Dow, S&P 500, and the NASDAQ last week.
We kind of needed that after all the
Yeah.
volatility we've been going through.
Yeah.
I mean, that wasn't much, but 1% is better
It's
than down
something.
1%, so we'll take it.
And the global equity markets rallied overnight in Europe and Asia, and there's no details about that. The U.S. Treasury yields are higher as the global banking picture clears up, and you touched on that.
Yields are higher,
higher.
prices are lower.
Yes. Crude oil prices and base metals are higher, while gold and silver prices retreat. First Savings has agreed to take over all the deposits and loans of the failed Silicon Valley Bank, as well as operate all 17 branches.
Yeah, and I think it's First Citizens Bank.
It is.
Yeah,
Yeah, First Citizens.
gotcha. Sorry.
Yep. And I want to talk about the year-to-date index returns. They're fluctuating a lot. Of course, S&P 500 is a plus 2.8%, Dow Jones is a minus 3%, and NASDAQ is a plus 13%. With that, thank you, Paul, and stay with us. We'll be back with our show called Your Money. Paul has an interesting topic. Stay with us. And we're back with Your Money. Thank you for staying with us. Paul Munichel is going to share with us some information about saving for college and what you need to know. I'll let you go with that, Paul.
Thanks, Ron. It's no surprise to anyone with kids at home that college is expensive. Costs can include tuition, books, room and board, and travel. And in many cases, the price tag of a 4-year degree can exceed 6 figures. Now, while actual costs will depend on the selected school, many families rely on a combination of savings, loans, grants, and scholarships to pay the tab. Whichever sources of funding you choose, there are important considerations to keep in mind as you plan for the expense of higher learning. And here's a few we're going to go over today. Number one, time is your friend. So the sooner you start saving for any long-term goal, the better. Save when your child is young to give your education nest egg time to grow. There are a range of tools available to help you save for future college expenses. One of those is the 529 plan, and it's specifically designed to pay for higher education costs. Contributions to the 529 plan are made on an after-tax basis and grow tax-deferred. These are tax-free. These contributions may be eligible for a state income tax deduction or tax credit. The principal portion of a 529 plan distribution isn't subject to federal taxes if used it the proper way. Additionally, the earnings portion of a 529 plan distribution isn't subject to federal taxes and in most cases state taxes, as long as the distribution is used for the beneficiary's eligible K through 12 and post-secondary education expenses, which include tuition, books, room and board, and when the beneficiary begins their studies. Now, besides the 529, a second option to look at is the Coverdell Education Savings Account, which also offers tax-advantaged savings. Income, eligibility, and contribution levels are lower than a 529 plan. Third option to consider could be U.S. savings bonds. They are lower risk investments that provide modest returns with limited tax benefits. A fourth option could be a custodial UGMA or UTMA account, which enables unlimited investing on behalf of a minor. Now, assets in the account can be used for anything, and earnings may be subject to taxes, and parents do lose control of the account when the child reaches maturity age. Another way to save on college costs is through a prepaid tuition plan, which locks in tuition at current rates and is available for a short list of state schools. You can fund the plan with installment payments. A longer list of private schools offers prepaid tuition through a private college 529 plan. You can also save for future college expenses in a regular savings account or individual retirement account, IRA. And then last but not least, I want to talk briefly about FAFSA. Your expected family contribution is calculated when you apply to the free application for financial student aid, otherwise known as FAFSA. Your EFC reduces the amount of eligible federal funding your student can receive. If you are unable to meet your EFC, you or your student may need to look to other sources of funding to fill that gap. And keep in mind, students can contribute too. Young adults who carry some of the financial burden of their degree may be more prudent about their college choice. They might be more motivated to start out at a community college or live at home and work part-time while attending college if it means taking on less debt. Don't ever forget, your future comes first. Most financial experts recommend that parents put their retirement goals ahead of their children's college costs. That's a personal decision that you'd have to come to. But students have a lifetime ahead of them to pay back school loans. Always consult with a qualified financial advisor who can help you create a financial plan designed to meet your family priorities. And also, when dealing with taxes, such as these college savings plans, always talk with a tax professional before starting, adding, or withdrawing from one of these plans.
Paul, you really shared a lot of options to consider. And then, of course, it depends on your portfolio and just what you feel comfortable with.
That's the thing. There are a lot of different ways to save for college, a lot of different options, and what might be right for you might not be right for me, and that's why you got to sit down and talk to someone.
Do you want to identify yourself if someone may have a question that's viewing the show?
Sure. If you've got questions on college savings or retirement planning or investing in general, feel free to give me a call directly at 708-226-3412.
All right, thank you, Paul. Thank you, Ameriprise Financial. For Paul Municle with Ameriprise, myself, Ron Jankowski, we wish you good investment day.